Pankaj Pandey is now joining us from ICICI Direct. Pankaj, morning. Pankaj, you guys at ICICI Direct are having a very wide universe of stocks to cover. Now that we are going into the earnings season, what are your expectations from the broader market? Any themes or sectors where you expect good results this time round?
So hi, good morning. Thanks for having me. I think overall, our sense is that from a Nifty earnings perspective, we are going to see 14-15% kind of earning growth. But when you look at from a historical valuation perspective, we are trading at about 22 times FY25 and about 19 times FY26. So obviously, multiples compared to historical precedence is on a slightly higher side. So our sense is that from going forward, possibly the returns in the market could be lower than the earning growth, and that is one of the ways to sort of correct the multiples. I think the only sector or the sector which is relatively looking quite good is the banking as a overall lot, because this is one sector where the valuations are still sort of okay. I think a lot of sectors, what is sort of getting priced is growth beyond 2 years and 3 years. And unless someone has that kind of outlook, possibly that is when you can look at that sector. Otherwise, banking looks quite good from the inflows perspective, also from a valuation perspective. And our sense is that overall, they can keep delivering mid-teen kind of overall growth because asset qualities are largely sort of okay. And infra is another name which we are liking. Cement has already rallied. We were liking cement a lot. But I think key to watch out would be the budget in terms of element of populism. Otherwise, earnings are largely okay to us. I think more than this quarter earnings, one has to sort of look at valuations.
Okay, fair enough. And where is it that you stand when it comes to some of those updates coming in from the banks? We just did a quick summary, and it's not just HDFC Bank. There's a number of them as well that haven't quite performed quite well. What do you think that this is indicative of, given the move that we've seen in an HDFC Bank, the cool-off yesterday, and in some of these other stocks as well?
So I think, say for example, in HDFC Bank, excluding merger, the advance growth is about 15-odd%, which is a sort of a steady number. I think the deposit accretion is still sort of a challenge, not only for HDFC Bank, even for other banks also. But it's trading about 2.3, 2.4 times. So valuation-wise, it's okay. Our target price is 1850 on the stock. I think most of the banks, our sense is that the advances growth is okay. The deposit is still a challenge. Relatively, we like PSU banks more because deposit is really not a challenge for them, and they are slightly better placed in terms of CD ratios. So we like the tier one names like, say, State Bank of India and Bank of Baroda.
Pankaj, another newsmaker is Raymond, demerging their real estate business. Just curious to get in your take as to how you're reading into this, the 1:1 ratio. Now Raymond Realty as well being listed as a separate entity. And as we were discussing, this is something that was sort of, that the shareholders were in favor of, and that sort of prompted this move. How are you reading into it from a shareholder perspective?
So real estate is one sector which has done phenomenally well, and our sense is that over the next 2-3 years, cycle is still going to be strong. But what we are sort of liking within the real estate is, say, something like Brigade or Mahindra Life. So Mahindra Life, for example, what we are liking is the kind of 5x kind of a business growth. What companies are sort of targeting. Our target there is about 740. Raymond specifically, you don't have a coverage. But I think you have very few stocks which can be bought at current levels in real estate, given the price appreciation a lot of these stocks have seen. So some bit of a time correction or a price correction is what we are waiting for.
Worried when it comes to the auto space. Of course, we're waiting for the world's first CNG bike launch by Bajaj Auto. We'll be tracking that. But what that could potentially imply for some of the other two-wheeler players, because it's going to be fairly competitively priced, affordable pricing is what they're looking at.
So I think within two-wheelers, what we are sort of liking more is Hero MotoCorp. I think valuation-wise, this is one company which is looking okay. And our sense is that if there is a bit of an element of populism in the budget, this is one stock which can benefit. Overall earning growth is expected to be about 15-odd% top line and 18% kind of a bottom line growth. I think Bajaj has already sort of done well. Valuation-wise, we are not comfortable to sort of recommend this stock. What we are like I just highlighted, is Hero MotoCorp with a target price of 6,620.
Pankaj, what is your thought in terms of the IT companies, right? While a couple of days back we had seen 2 upgrades that came in for Wipro, and yesterday there was a downgrade for Wipro. Anything specifically that you're looking from the IT pack, and what is your view there?
So IT probably is one sector which has not done well from a price performance perspective, and our sense is that this year is largely going to be washed out in terms of overall growth in terms of earnings. I think FY26 is where one can sort of pencil in some hope. So we are selectively looking at some stocks. So for example, Tech Mahindra, we are liking largely because our sense is that if they are able to sort of achieve this 2027 target of 15% EBIT margin, you have decent upside there. Similarly, we are liking Birlasoft because our sense is that while it is trading at about 22, 23 times multiples, but this is one company which can deliver low teen kind of a top line and bottom line growth. We are chasing pockets where growth is slightly on a better side rather than sort of a broad-based outlook. I think most of the companies, our sense is that it is still not time enough, or it is still too early to sort of chase some of these stocks.
Pankaj, another newsmaker is Raymond demerging their real estate business. Just curious to get in your take as to how you're reading into this, the 1:1 ratio. Now Raymond Realty as well being listed as a separate entity. And as we were discussing, this is something that was sort of, that the shareholders were in favor of, and that sort of prompted this move. How are you reading into it from a shareholder perspective?
So real estate is one sector which has done phenomenally well, and our sense is that over the next 2-3 years, cycle is still going to be strong. But what we are sort of liking within the real estate is, say, something like Brigade or Mahindra Life. So Mahindra Life, for example, what we are liking is the kind of 5x kind of a business growth. What companies are sort of targeting. Our target there is about 740. Raymond specifically, you don't have a coverage. But I think you have very few stocks which can be bought at current levels in real estate, given the price appreciation a lot of these stocks have seen. So some bit of a time correction or a price correction is what we are waiting for.
Worried when it comes to the auto space? Of course, we're waiting for the world's first CNG bike launch by Bajaj Auto. We'll be tracking that. But what that could potentially imply for some of the other two-wheeler players, because it's going to be fairly competitively priced, affordable pricing is what they're looking at.
So I think within two-wheelers, what we are sort of liking more is Hero MotoCorp. I think valuation-wise, this is one company which is looking okay. And our sense is that if there is a bit of an element of populism in the budget, this is one stock which can benefit. Overall earning growth is expected to be about 15% top line and 18% kind of a bottom line growth. I think Bajaj has already sort of done well. Valuation-wise, we are not comfortable to sort of recommend this stock. What we are liking, like I just highlighted, is Hero MotoCorp with a target price of 6,620.
Pankaj, what is your thought in terms of the IT companies, right? While a couple of days back we had seen 2 upgrades that came in for Wipro, and yesterday there was a downgrade for Wipro. Anything specifically that you're looking from the IT pack, and what is your view there?
So IT probably is one sector which has not done well from a price performance perspective, and our sense is that this year is largely going to be washed out in terms of overall growth in terms of earnings. I think FY26 is where one can sort of pencil in some hope. So we are selectively looking at some stocks. So for example, Tech Mahindra, we are liking largely because our sense is that if they are able to sort of achieve this 2027 target of 15% EBIT margin, you have decent upside there. Similarly, we are liking Birlasoft because our sense is that while it is trading at about 22, 23 times multiples, but this is one company which can deliver low teen kind of a top line and bottom line growth. We are chasing pockets where growth is slightly on a better side rather than sort of a broad-based outlook. I think most of the companies, our sense is that it is still not time enough, or it is still too early to sort of chase some of these stocks.
Right. Okay, so that's the word coming in on the IT pack as well.
A quick word, Pankaj, on cement.
So I think we are liking cement as an overall pack, with ACC being the top pick. Our sense is that while pricing is definitely a difficult thing to sort of pencil in, because we are not looking at pricing increase. I think overall, whichever companies, with say for example, tier two companies like say Birla Corporation, Sagar Cement, or even for example Ramco. So Ramco, for example, specifically witnessed one of the steepest sort of declines in price realization, given the fact that the pricing in South is overall weakish. But our sense is that largely most of the M&As are happening at $90 to $100, so below replacement cost. So whichever companies are trading below that, I think are decent or good targets to be sort of looked at. So cement, we are quite constructive because our sense is that given the overall push what government is going to sort of do, especially on the infrastructure creation, I think cement looks good to us.
FIIs, they continue to pour in money, and for an 8th straight session, you've been seeing FII buying kick in. And yesterday was no different. Pharmaceuticals, technology, some of the private banking names, they all held out in trade yesterday too. Pankaj, just wanted your sense in on pharma, because that's made quite a strong comeback. You're seeing now brokerages as well up their price targets. Yesterday was Lupin being a case in point. Anything that you're liking within the sector?
So in pharma, we are liking two, three stocks. One within large caps, so we're liking Orbindo Pharma with a target price of 1475. I think our sense is that overall, this is one company where the specialized portfolio sort of shaping up well. Last quarter did a growth of about 44 odd percent, compared to about 18% kind of a growth what you see for US. So US market is expected to sort of do well for them, and valuations are okay. Another stock what we are liking is Glenmark Life Sciences. I think this is one API company which has been supplying to a lot of companies. The current capacity utilization is somewhere about 85%, and our sense is that this company would be looking at further expansion in capacities. And here our target price is 1,040. So I think selectively we are positive on pharma, but not all of them.
Quite interesting.
Pankaj, wanted to also get in your take as to what the outlook is when it comes to individual stocks within that we see in the recent listings of anything within the new age tech space that you would favor, or any of the recent listings and IPOs that have been hitting the street?
We've been very selective in terms of chasing stocks because our sense is that you need to see stocks for a considerable period of time before we recommend. I think IRIDA is what we have sort of recommended because our sense is that this one PSU AAA rated can deliver 30% kind of a AUM growth, while valuations are on a higher side, but we like the opportunity size. Then we have come up with a buy rating on Ratnavir Engineering. So this is another company which makes stainless steel sheets. There our target price is about 200. Our sense is that top line can sort of jump from say 600 odd crores to 900 odd crores. Bottom line could effectively double. So this is another stock which I have been liking the IPO, although it had come last year. But we are very selective in terms of chasing IPOs.
Absolutely. But Pankaj, other than the list and the stocks that we've talked about, where else do you have a bullish bias and still find value on the table and are recommending buying?
I think we're liking auto as an overall lot. So all the tier one names, be it Mahindra and Mahindra, be it Tata Motors, or even the battery players. So we are liking auto as the entire pack. Two-wheeler I just highlighted. Then I think you have select PSUs, especially say for example a company like NMDC, Coal India, NTPC. So I think these companies are quite okay from a balance sheet perspective. Plus valuations are okay. And then I think overall. One has to be very selective because a lot of stocks have done very well. There are some pockets like defense, bit difficult to sort of justify because most of them are trading at 50 times or around 50 times 2 year forward. Unless you take a very longish view, it's very difficult to sort of justify the current price levels for some of them.
Talk about Aditya Birla Fashion, Trent, they were buzzing, and yesterday we had the smaller one, Monte Carlo Fashions, also buzzing in trade. How are you looking at this in terms of the charts and technicals? Would you be looking at a smaller play like Monte Carlo Fashions also now?
So I would be looking at Shoppers Stop. That's gone sideways for the last 1.5, 2 years now. And before that, it was a trending one. But unlike the other names, there has been zero volatility. The stock has been at 700, 800 for the last almost 6, 8 months. Yesterday saw a little bit of a spike up. The recent swing highs are around 810, all-time highs around 850. So that could be the one which could be next off the block in terms of momentum. A classical triangle formation here, which could actually consider to be a breakout move going forward. So that's the first name as of now. Aditya Birla Fashion Retail is interesting for the fact that the stock is back to the prices of 330, 340. This is where it topped out in 2022 and 2023 also. In that period, there were three tops at 310, then three, four tops at 340, 350. Seems like finally the stock is off the block in terms of the trends. Pre-COVID also the stock was at 280, so has done nothing much over the years. So ABFRL continues to be a slow and steady mover, but Shoppers Stop could be the next one which could break out and give a meaningful move towards 1,000 rupees going forward.
Okay, I also want to bring up some of the realty charts. While, of course, there's a lot of excitement around the Raymond demerger, which has been announced, and what value Raymond Realty is going to incur. But some of these names, the likes of an Anant Raj, for instance, which got a upgrade by one of the brokerages just day before. Then, of course, Godrej Properties has been a very strong one. And today you've got news flow come in on an Ahluwalia contracts as well. That, of course, is the larger infra theme that I'm talking about. But yeah, in specific realty, its ancillaries, all doing very well. Pankaj, within the pure play realty majors, what is it that you're liking right now, and where is it that you find valuation comfort?
Valuation comfort is with Mahindra Life. I think we are putting a 50% premium to their NAVs. I think target price there is 740. Otherwise, Brigade also looks quite good to us. A lot of these names have done very well beyond our sort of target prices. So comfort-wise, these two stocks.
You coming in on the entire real estate space. In the meantime, Pankaj, what about your thoughts on what the outlook is when it comes to some of these FMCG names? We have seen those sporadic moves coming in, valuations still looking fairly stretched, and you have a lot of hopes on rural picking up. Could that be a key trigger for FMCG and some of these rural linked stocks?
I think some bit of a price uptick cannot be ruled out, but I really do not like this space from a structural perspective or even from a portfolio perspective. I think if I have to sort of suggest probably a consumption theme, then hospital is one consumption theme which can do very well, hotels or even the autos, be it four-wheeler and two-wheeler, those look relatively better to us. I think overall FMCG, while margins were elevated last year, this time around companies have started to sort of do some bit of a pass on of pricing benefit or input price benefit. But sum total, you're not going to sort of deliver growth in double digits, which is where the sort of challenge lies. So not really liking this space. We have not been recommending much, except for the fact that in the budget, you might see some bit of upside of say 8 to 10 odd %. But those are largely technical calls.
Pankaj, what's the chatter around IT? Because, while the stocks have done what they have done and the IT index as well, both on a monthly as well as weekly basis, has shot up quite a fair bit. But does it seem like it's going to translate into good earnings or at least better commentary from IT majors when shortly they'll have their numbers?
So result-wise for Tier 1 really does not look much of an excitement. I think probably the excitement can happen in FY26 or when you see the commentary, especially from AI-driven sort of revenues. But I think those are still sort of early days. I think IT is relatively getting a benefit of underperformance in the past 1 year or more. And I think one has to be very selectively positive on IT because I think till the time US does not witness a rate cut, it does not look like that the banking and financial services, which is the biggest tech spender there, the tech spend is going to revive. So that is still some time away. And even structurally also, we are not very positive because it used to deliver double-digit kind of a top-line growth with currency depreciating 4 to 5%. I structurally believe that currency is not going to sort of depreciate. Like FMCG, this is another sector which will sort of deliver probably high single-digit kind of a growth at max. And unless the AI does some magic for that, I think we still need to sort of wait and watch for.
And didn't participate in the move for the private banking names. But the fact that the deposits have come in soft this time around, the CASA ratio stands at 36.3 versus a comparable of 38.2 on a sequential basis. Maybe some more easing off is what you will see on the stock. And already the pre-open rates are indicating another 2% of a dip for HDFC Bank. Having said that, if you just bring up the 1 month chart for HDFC Bank, that in any case has done a whole lot well. So I don't think that 2% fall yesterday, another 2% today is going to completely undo all of the gains that you've been sitting on. And maybe soon you will see some buying kick in for HDFC Bank after today's damage. So there you go, almost a 9% uptick is what the stock has already seen in the last 1 month or so. But Pankaj, other than what you're bullish on right now, tell us what is it that is a complete avoid according to you in this market?
So given the inflows, there is nothing which is called complete avoid in the market. Even like I said, a sector like FMCG also could witness price performance. So nothing is avoid because you are sort of competing with other asset classes. So I think equity relatively is one of the best asset class to be there for the next 5 to 6 years, barring some gold exposure, what one can take. Nothing is avoid, I think. But yes, relatively, some sectors like, say, IT, FMCG wouldn't sort of chase them or wouldn't suggest them from a portfolio perspective.
Thanks so much then, Pankaj, for joining in and sharing with us your outlook on the markets.
If you like this video, then like, share and subscribe to ET Now.